OSWALD companies. I'm the surety practice leader. OSWALD is a all-lines insurance broker and bonding company agency, insurance agency. We've been in business here in Cleveland since 1893. I've been in the bonding business for 26 years now, 17 of that on the company side, or 18, and nine years on with the agency side with OSWALD companies. Surety bonds are very similar to banking in a lot of respects. It's a credit function. So it's all, and I tell people who I work with who don't understand surety, even at my own agency where I work, I said, just think of it as banking. Then they tend to understand it more. It's all credit-based, very similar to banking. But it's a product that's handled in the insurance industry, okay? While it's very similar to banking, we're set up a little bit differently, okay? The surety industry works almost exclusively through agents, okay? Whereas with banking, you go directly to your banker, okay? In the bonding world, in the insurance world, you probably all have insurance agents you deal with to get your insurance, right? Well, same thing with bonds, okay? Bonds is a very specialized area, though, so many times your insurance agent will not have bonding expertise, and that does not help you, okay? That hurts. But in any event, to get to the bonding companies, you got to go through an insurance agent, typically, okay? I think the reason our industry, the insurance industry is set up that way is it's a very, very complex industry. I mean, there's thousands of products, just all kinds of different things that the insurance industry does that can be very complex. So I think the reason it's set up that way is just so the agents can kind of guide people to the right place. With that as some background, one thing I will say about bonding is a lot of times it helps people if you know how to get work without providing a bond, okay? I'm not here to say, you need to get bonds. I would say do everything you can, okay, to not bond your work, okay? Bonds are typically required from two sources, okay? Public entities, if you work directly for a public entity, and the project's of any size, okay, typically, I don't know, 100,000 or more, okay, by law they're required to have you post a bond, a surety, a performance and payment bond. I think in the city of Cleveland, though, they actually have the ability to waive a bond for a project up to $500,000. They got an ordinance passed 3 or 4 years ago because a lot of smaller contractors are having trouble getting bonds. So, well, they don't have to do it, they have the ability to waive it. So bonds are required by public entities. Bonds are also required by private companies. Many times a general contractor will want to bond his subcontractors. It's typically larger subcontractors they want to bond. A lot of times they're not worried about the guy who's got a $50,000 or $100,000 or $200,000 subcontract, but they want to bond the guy that's got the $500,000 or $1 million or $2 million subcontract. So, but if a general contractor comes to you and says, hey, you got a $300,000 subcontract, you need to provide a bond, okay? I would go to and you don't have any bonding in place and you know it's going to be difficult, go to that owner of that general contracting company and talk to him and let him know why you're a good business. Show him your financial statements and say, look, I can't get bonding, but I'm a good business. A lot of times you can talk to these general contractors and get them to waive a bond, okay? So that's the first thing I would say is in the bonding world is try to get your work done without bonds. Only put up bonds and you have no other recourse, okay? All right, now what I want to really do today is we're going to talk about these first 2 pages on here, and the second page is a worksheet that we'll spend a fair amount of time on going through. But my goal is to really take you behind the scenes, behind the curtains, okay, and tell you exactly what goes on in the world of bonding. There should be no secrets. Everything should be transparent here. And most people, I would say, in business do not understand bonding very well, okay? And so that's part of my goal today, is to really let you know how this business operates. The first thing you want to do there, section 1, is understand where you fit in the surety world, okay? Many of you may or may not know that, but you're going to be in one of these 4 places right now, okay? The first is what we call the standard surety markets, and those are the contractors that probably been getting bonds for a while. They've got a lot of money, or they've got $500,000 in equity and $400,000 in working capital or more, or whatever, and they've had a long-time relationship with a bonding company, and that's where they're at. Travelers bonds them, or CNA, or Hartford, or one of these big insurance companies. If you're not in the standard surety markets, but you're getting bonds, there's a good chance you're in the next category, what we call the non-standard or secondary surety markets, okay? These are typically smaller insurance companies and that have small bonding divisions, and they'll write bonds up to maybe $1 million or sometimes up to $2 million for a single bond. But they'll charge you more for it. They might take some collateral. They might want to have you put up a letter of credit from a bank. Like, say you want to bond a $1 million job. Well, they may say, fine, I'll bond that, but you need to give me a $300,000 letter of credit to hang on to. Okay, I want a little bit of real security. They may do something called funds control, where, and this is actually an interesting way to get a bond, okay, if you don't have any money, okay? Say you got a business, you say, look, I don't have much money, okay? There are some sureties out there in the secondary markets that'll say, fine, you got a good credit history, okay, your business and personally, but you don't have any money in the company, you don't have much personally. If you do funds control, we'll write a bond for you. And what that means is the owner agrees to send the money, okay, to an escrow company, okay? So when it's time to pay you the $50,000 draw, the owner sends that 50 grand to the escrow company. The escrow company gets your billings, okay, and they look at all that, because what the sureties are really worried about is you not paying somebody. They're worried about you not paying a subcontractor or supplier or laborer, okay? They're really not worried so much about the performance of the project as they are about you not paying somebody. Because remember, it's a performance bond and a payment bond, and we'll get to that in a minute. But so what the funds control does is the escrow service, they make sure that whoever's supposed to get paid gets paid. So they'll write a joint check to you and to XYZ Supply Company, okay? So that takes all the risk out of the payment side of the performance and payment bond. So that's something that a lot of people don't know about. But it's a good way to get bonds sometimes. Not every surety does it. Again, you got to look around. Get on the internet. Do some searches, Google searches. I mean, you'd be amazed what you can find on the internet.
What is that called again? Non-standard.
Non-standard markets, or we also refer to it as secondary markets. I mean, same thing in the surety world. But the standard surety markets, they don't charge, high rates and take collateral and funds control. Generally speaking, they don't do that. On a rare occasions, they will, but the standard surety markets are pretty much, everybody's kind of got a very competitive rate, and they don't take collateral, they don't want funds control, that kind of stuff. There's also another good place to go, item C there, what we call the fast track markets, if you don't have much money. But again, all this is predicated on you get good personal credit and good business credit, right? Airden talked about that. Again, very similar to banking. They'll run a personal credit report on you, whether it's Equifax, Experian, or what's the third one? They get the 3 guys on TV, and just make sure one of those guys isn't ugly, But so as long as your personal credit's good and your business credit, they'll probably run a Dun & Bradstreet on you. That's what most of the sureties usually use. Just to make sure, they want to make sure you don't have any big lawsuits or liens or judgments outstanding from a business standpoint and personally. So basically what these fast track markets do is they'll say, look, we won't even look at your business financial statements, okay? Just fill out an application, tell us what the job is, brief description, okay, amount, name of the owner, I mean just the basic information on the job, okay? And then they'll run your personal and your business credit, and if your personal and business credit are good, chances are they're going to write the bond for you. But again, they'll only do this for jobs up to about $200,000. If you get over that, you really can't get much done in those markets. Old Republic Insurance Company, they do this. C&A Insurance Company, they do this. Those are a couple off the top of my head. But again, Google, search the internet. You can find these places.
That's available to both subs and GCs?
It's available to anybody, yeah.
Will they write multiple bonds?
Yes, yes. Typically, they call them a 2x4 program, so they won't write more than $400,000 total aggregate. Okay. They'll write up to $200,000 single and $400,000 aggregate.
Okay, so once you get one or 2 of them, let's say for $200,000, then chances are
you'll be able to get another one, yeah. And then finish that job and go get another one, yeah. They probably charge you 3%. That's typically the rate, that you see in that marketplace. The standard markets, the non-standard and secondary markets, which the fast track market's really part of that world, but little bit separate, because the fast track markets are done by standard surety companies too. But in items B and C there, they'll typically charge you, roughly 3% is what you're going to pay for a bond.
We hear that a lot with, contractor or subcontractors just stipulating that, I don't have a bottom line.
Yeah. Well, tell them there's, tell them to find one of these fast track markets. Yeah. Or they're also known as 2x4, okay, or 3x5. I think, somebody's got a 3x5, I think, even out there, So, but most of them are 2x4, which means 200,000 single, 400,000 aggregate. Item D there, if you've got no money and bad business credit or bad personal credit, you're probably not going to get a bond, okay? All right, so let's just cut right to the chase, all right? All right. But you got to know where you stand. All right. Next item, just understanding bid performance and payment bonds. Some of you probably understand this, some of you may not, but a bid bond is usually some percentage of the contract, 5, 10, 15, 20%. All that does, it's a pre-qualification item. It lets the owner know that you're bidding to, or the GC or whoever, that you're bondable. So if you're low and they want to award you the project, they know you can probably get a performance bond, because no one's going to give you a bid bond unless they pre-qualify you and say, yeah, you're good, okay, you want to bid a $200,000 job, fine, we'll give you a 10% bid bond. And so if you're low and you're awarded the job, they're going to write the performance bond, performance and payment bond. Jobs that require bonding usually require both a performance and payment bond. There's no difference in the cost. They come together or they separate. I mean, there's no difference. If you just need a payment bond or a performance bond only, no payment, it's still going to be the same charge. So they come together or separate, but usually always a performance bond is required. And most of the time a payment bond is required as well. The performance bond simply guarantees the contract. That's all it does. It says you're going to perform the contract according to specs and the price and everything else. And if you don't do it, the surety's there to stand behind it and make sure it gets done. Typically, the performance bond is written for the same amount of the contract amount. Sometimes, and this can help you with bonding, negotiate it down. Maybe you've only got $500,000 of bonding capacity, okay? The largest single bond you can get, and you want to bid $1 million job to a GC or something like that, all right? In the public world, you won't be able to negotiate, but in the private world, you can go negotiate anything. Say, look, I'll give you a $500,000 bond on this $1 million contract. Well, that should be plenty sufficient, because what we call the probable maximum loss in our industry, whenever there's a loss on a bond, the average loss is 35% of the amount of the bond, okay? So if somebody's got a bond for 50% of the total project, they're well covered typically. It's just extremely rare to have a loss in excess of 50%. So that's another way to help you with bonding. The payment bond just guarantees you're going to pay all subs, material suppliers, laborers. Anybody that you owe money on that project, they're going to get paid. If not, they can make a claim on the bond. Okay, now the next is the worksheet. And if somebody wants to give me like the 2 or 3 minute signal, because I'm going to go through a lot of stuff, and wherever I'm at, I'm going to try to go fast. This is really the next sheet. Everything that's on there and under section 3 is on the next sheet, pretty much. I want to go through this with you so you can say, well, what are the bonding companies really looking at, right? And then let me evaluate myself, okay? Now, there's no formula here where you can say, well, look, if I meet, 12 out of 15 of these, or I don't know how many are on there, I get bonds. I mean, any one of these could potentially knock you out, okay? So you don't have to be good in all of them, but you just got to understand where you fit in all these, because when you go to get bonding, right, you want to know how the game's played, right? And if you know you got a weakness somewhere, you want to address that up front and say, look, I got all this stuff covered, blah, 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 blah. Here's one issue, we got to deal with it. And again, a lot like the banking, a lot of times there's ways to deal with things, okay? Sometimes there's not, but a lot of times there is. The first thing the sureties are always looking at is working capital, okay? Working capital is simply, and it's in the parentheses there, your current assets less your current liabilities. Now, the sureties will do some adjustments, perhaps, to your balance sheet, but to come up with what they believe are really the current assets and current liabilities. But generally speaking, If you want to carry a backlog of $1 million of work left to complete, okay, at any one time, the sureties like to see you have $100,000 of working capital, okay? That's a rule of thumb. I mean, it could be more, it could be less. Typically, it's not more, but it could be less than that too. Equity. They want to see your equity, or tangible net worth, right, at 10% of your backlog as well. Could be less. Typically, they're not going to want to see a lot more. But again, equity is just your total assets less your total liabilities. Profit. Sureties want to bond companies that are profitable. If you're consistently not profitable, it may not be a problem, but if you're losing a lot of money for a lot of years, that could be a problem, okay? But generally speaking, if you're a profitable business, obviously it just makes it easier to get bonding. Do you have to be profitable? No. But just keep in mind, a surety doesn't want to bond any company that they think has got a good chance of going out of business this year, okay? You know, they want to make sure that whatever they bond, if it's a 6-month project, you're going to be around after it's that 6-month point, okay?
Is there a normal profit that they're saying, well, you at least have to have 5%?
No. I mean, when a surety evaluates your company, they'll see what your gross margins are. In general, on an aggregate basis on the income statement, they can look at your gross profit margin, which is all your jobs, you know, thrown together. They can look at your job schedules, and they'll see some jobs are in 2%, some jobs are in 15% gross. I mean, it can be all over the map with a contractor. I think in general, what's important is that you're profitable overall. That's the most important thing. So, you know, some contractors need to have 30% gross profit to make money. Others only need 10% gross profit to make money because they have a different overhead structure. You know, it all depends on, you know, your business, how your business is made up. They like to see that you have some bank line of credit availability. Just because you have a $100,000 bank line doesn't necessarily mean everything's okay, because if it's fully borrowed, okay, then you got no more ability to go get liquidity, right? Sureties just want to make sure you got access to cash somewhere, okay? So they like to see that you got a bank line of credit and that there's a decent amount that's not used. And they don't like to see you dependent on it, just, you know, you're totally always dependent year after year after year on your bank line to run your business. They like to see that you can pay it off too sometimes, but again, some businesses don't, and it's not always a problem. But again, the whole point there is sureties just want to see that you've got somewhere to go to get some banking liquidity.
Is there a rule of thumb there for GC's perspective?
You know, there's some broad rules of thumb. I would say if you're doing $5 million a year in sales, okay, which is a medium-sized contractor, you know, you should probably have at a minimum a $250,000 line of credit, probably between $250,000 and $500,000. If you're doing $1 million a year in sales, you know, you might have a $50,000 or $100,000 line of credit, you know. I mean, $10, $20 million contractor, you probably need a $500,000 to $1 million at the minimum, you know, line of credit. So those are just some broad ranges. But the surety industry doesn't say, look, you got to have this. They just want to see that it's, you know, relatively adequate.
What are they looking at, financial statements or tax returns?
They're looking at financial statements. They will sometimes, some sureties will ask for a copy of your tax return, but most of the time not. They want to see your internal statements and your outside CPA prepared statements if you have an outside CPA. It always helps if you do have an outside CPA. Prepare your year-end financial statement.
Review audit.
Sure.
And typically, you're looking at accrual basis.
Yeah, the surety industry likes to see accrual basis because that presents things in a more accurate fashion from their, and specifically the percentage of completion accrual method, which for contractors is the most accurate because I don't mean to get down to the weeds here, but it's the cost-to-cost ratio. You know, your cost incurred to date versus your total estimated cost on a job, whatever that percentage is, you know, 14%. That's how much you're complete on that job. So you've recognized 14% of the revenue, you recognize 14% of the profit, you know, that kind of stuff. Those are the most accurate financial statements as far as the surety's concerned. Personal credit history, I don't need to belabor that. Just keep it clean. If you got a problem on it, try to get it cleaned up or be very upfront and open with the surety. Just say, look, I got a situation, here's what happened, and just be totally upfront with it. You don't want to surprise the surety. You don't want to go to your agent and have them do all this, and then they run a personal credit report, right? And it comes back with something pretty negative on it. You want to be upfront about that, and a lot of times just because you're upfront about it, may make things okay. The biggest thing for sureties, one of the biggest things, is they don't like to be surprised. So just tell them everything. Personal financial statement strength, they like to see, because bonding companies 99% of the time require personal guarantees just like banks do. They like to see that you got some personal net worth. It's not always required, but the more personal net worth you have, obviously it only helps. Item H, they like to see that you've got experience in construction and that you've got a plan. If you just come and say, I want bonding, and you don't have much experience in the business you're in, or you don't have a plan, because a lot of these sureties will say, hey, what's your business plan, right? And you've either got to be able to explain it pretty well, or it's even better to have it in writing, Sureties love paper. They love to see things in writing. The more you can give them, the better.
If they do have a business plan, if I may ask, should it be revisited frequently, or how?
Yeah, at least annually, I think is normal for folks to update a business plan. Sure. And it may not change a lot, but on an annual basis, but I would say annually. And when you have a written business plan, if you know what you're doing, you're going to probably write a pretty good plan, and that comes through. I mean, you might know what you're doing, but if you don't put it on paper for somebody to see it and understand it, you're kind of shortchanging yourself if you really know what you're doing,
Excuse me.
Yeah.
I have a little bit confused about this where it's construction. It says personal experience in construction.
Mm-hmm.
Like physical construction?
Well, for example, let's say you want to be an electrical contractor, okay, and you want bonding, right? If you've never worked in the electrical construction industry ever, that's not a good thing from a surety's perspective. They want to see that you've worked at least for an electrical contractor, or yourself.
Okay, so no matter what the business is, as long as you have that personal experience.
Yeah.
In doing that.
Yes. Yeah. That helps a lot. Now, absolutely. I mean, you think about it. Would you want to bond somebody if they had no experience in the business that they wanted you to bond them for? I mean, probably not. The other thing to always think about bonding is this will help you a lot, and this is how underwriters operate. Would you guarantee it personally, okay? If somebody came to you and said, I want this $500,000 bond, okay? Would you guarantee it personally? And that's how these guys operate, these underwriters. They ask themselves that question. If I was going to put my money on the line and you're going to pay me the premium, you're going to pay me $5,000 in premium, okay, to write this bond for $500,000 or whatever the number is, $10,000 in premium. Would I do that personally? Would I feel comfortable with that? So these guys are asking themselves that question all the time. That's how they're trained. Probably banking's, I would think, similar in some respects. Business credit history, again, it's always good to have a clean credit history. If you got pending judgments or lawsuits or liens, that's a problem. And if you got something hanging out there, address it up front and be very clear about it, okay? Because the surety can maybe understand it, maybe it's not a big problem. But if it comes up on a credit report and you got to explain it, it's just, you're starting from a kind of you're starting from a much lesser position in your negotiation. A completed job history. A surety will look at what have you done in the past. Okay, you want to say $1 million bond, right, for $1 million project, but the largest project you've ever done is $75,000. Yeah, I don't think so. Okay, I mean, sureties will typically take steps up in 2s or 3s. Three's kind of stretching it. So if you've done a $300,000 job, they'll probably bond you for a $600,000 job, maybe maybe a little larger than that. But to go 10 times what you've done in the past, I mean, it's, that's asking a lot typically. So they just want to know that you've done work successfully, and they'll want to know what type of work and how big it was. They will require your corporate and personal signatures almost all the time. It's very difficult to get away from unless you're a big contractor with a ton of equity and, you know, millions and millions of equity and, you know, all that kind of stuff. They like to see that you've got internally prepared business financial statements that are accurate, and these surety underwriters have been around a long time. They can tell if these statements are adding up, okay? So that helps you when they know you've got a handle on your numbers. You know what your numbers are. They feel that helps them because they know if you got a problem, you're going to see it early on and not 6 months go by and you're like, well, I didn't know I had a problem, you know. The quality of your outside CPA, the sureties look at that. Does this CPA know construction? Okay, some CPAs don't know construction, and construction is kind of a unique accounting area. So it helps if your CPA has a background in construction. And the higher the level you get, a review or audit helps as well. If you're a small company doing, I mean, the rule is a thumb in the surety industry. If you've only got a compilation, I mean, what that is, it's just your numbers, the CPA puts them on his letterhead, and that's about it, right? You might be able to get a bond up to $500,000 with a compilation, roughly. I mean, sometimes a little more, but it's rare. But the review and the audit, I mean, forget about an audit. You don't need an audit unless you're probably a $15 or $20 million company. But a review will get you a $1 million bond, okay, if you qualify, or a $2 million, or $3 million, or 4 or 5, or whatever. You can get a lot of bonding with a reviewed statement. Where a compilation, if you got a good, strong business, you might as well get a review if you need large bonds, right? Because it's hard to get. Now, you can still get large bonds with a compilation, some sureties, but it just makes it a lot harder. Percentage of completion construction accounting is good. That's the accrual method. It's one of the accrual methods. It's the very typical one that a lot of contractors use, but at least use the accrual method. Job schedules, they want to know that you know, they'll ask to look at your backlog, give us your work on hand, right? We want to look at all your jobs and see what the numbers look like. Matter of fact, turn to the next page. Here's an example of a pretty simple job schedule format. You can have more columns and data, but this is about the bare minimum information a surety would want to see on a job schedule, right? A brief description of the contract, you know, what the amount is, what's your total estimated cost to completion, what's your total estimated gross profit, you know, what are your direct costs to date, how much do you have left to complete, and then, you know, how much have you billed to date. That's the basic information a surety wants to know on when they look at your work on hand. They'll look at the difficulty of your work and the geographic spread. Obviously, some work is not very complex, right? I mean, if you need a bond to, you know, lay floor tile, I mean, that's not very complex or difficult work. That's a lot different than building a road or building, okay? So they'll look at the difficulty of your work and the geography. You know, the farther away you go from home, the more difficult, you know, the higher risk it is. I mean, if you're an Ohio company and you want to do work in California, the surety's going to go, wait a minute here, you know, that doesn't make any sense. Not all the time. But I'm just saying, in general, the farther you get away from home, it can create some problems for a surety, simply because you can get into environments that you don't know very well, and people in those environments may not want you to succeed and can do things to hurt you, you know. So sureties understand that. They've been around the block. Warranties, sureties don't like to bond jobs that have a warranty of more than a year, so don't tell somebody you'll give them a 5-year warranty that'll be bonded, because the surety's not going to bond a job with a 5-year warranty in it. They'll bond jobs for 1 year, sometimes up to 2 years. 1 to 2 years is their comfort zone for warranties. The sureties just don't want to be on the hook on a long-term basis. They want to get the work done and then know that a year after that they're done. Because their performance bond also stays in place while the warranty's there too. Because again, it just guarantees your contract.
Well, how does that work with, like, you know, sometimes there's like a roofing warranty, like a 20-year warranty?
Yeah.
How does that, is the bond followed for 20 years?
Well, there's a couple things. One, those roofing warranties are usually pass-throughs to the roofing manufacturer, okay? So if it's a big, well-known roofing manufacturer, sometimes the sureties can be comfortable with that, okay? Because they know it's a pass-through guarantee, okay? If there's a problem with the warranty on the roof, it doesn't go to you, Mr. Contractor. You're just going to turn around and go to ABC Roofing Supply Company or whatever. Sometimes, though, the surety will say, yeah, you need to give them that warranty outside your contract that we're bonding. We'll bond your contract and give you a 1 year, that has a 1 year warranty. If you want to give somebody a separate warranty that you want bonded for 20 years, we're not going to do that. I mean, and most sureties just won't do that. They'll say, fine, give them a warranty, but not in the contract that we're bonding. Give it to them separately. But again, sometimes if it's a large roofing supplier, house, or whatever, and it's a pass-through warranty, sometimes you can get a surety to go along with it. Just, it's hard to know up front. The last item there may be one of the most important ones, though, the quality of the agent and their surety knowledge. I mean, again, most agents out there, 99% of them are insurance focused, property and casualty, employee benefits, that kind of stuff. And bonding's a real specialty area. So there's very few people here in the city of Cleveland that can get up and talk about the kind of things I'm talking about, because there's not very many of us. Most insurance agents don't know that. So if you want bonding, when you talk to an agent, one of the things you should probably ask them is, do you have other clients that you provide bonding for? And, if so, who? And maybe even get some references. And ask them a few questions. I mean, if your agent doesn't understand this kind of stuff, okay, they're not a bonding agent, So. The last thing, we'll turn back to the front. So you can grade yourself on all these items and see how you stack up,
I have a question about K and L. I kind of missed them. Can you just review those very briefly?
K and L?
Yes.
K just means that any surety is going to require that both the business and the individuals that own the business stand behind and guarantee any bonds.
Oh.
Just like you're signing for a bank loan, you're going to sign for the bonds.
Okay.
Yeah.
And L.
And L is, they just want to make sure that you prepare business financial statements, that you have internally prepared statements, okay?
Oh, okay.
That you don't just wait for year-end and your CPA to prepare a year-end statement, that you know on a monthly and or quarterly basis at a minimum where you are.
Okay.
Yeah, that you can prepare those.
Okay.
QuickBooks is typically fine for that kind of stuff.
Okay.
Anyways, back to the front, and I'll wrap up here on the section 4. Actually, under section 3, there's 2 more items on the front, items S and T, because these aren't really places for you to grade yourself, so they weren't on the back. But surety premiums, I think I covered some of this before. In the non-standard markets, you're going to pay about 3%. In the standard markets, it ranges, but you typically pay 1 to 1.5%. Sometimes 2%, but it's somewhere between 1 and 2% typically in the standard markets.
Isn't that still on the graduation scale? I mean,
Yeah.
500,000, it may be.
Over 500,000, it'll start dropping down typically, yeah. Some resources for you. You get on the web, actually it's under section 4 too. The first one is SIO, that's the Surety Information Office. It's a partnership of all the big insurance companies and the surety agents around the country, called the Surety Information Office. They got a ton of information about bonding. Or you can go to the SBA website. They've got information about bonding. Matter of fact, I printed out a couple pages here from the SBA website. This is a place that can help you get bonds because they'll back it up. Either 80 or 90% guarantee to the surety company from the federal government can help you get a bond. At OSWALD, we don't operate in that environment, but other agents do. So again, just get on the web, call around. That could be an interesting place for you to get some bonding if your financial statement isn't that strong. All right. It helps if you can talk to the actual surety underwriter as well, just like you want to talk to your banker. So don't always just rely completely on the agent. You like to talk to one of the underwriters. And then you grade yourself, and I would just say focus on improving your attractiveness to a surety. I mean, you might not be that bondable today, or you may not be able to get the size of bonds you want, but now that you know what to focus on, right, just keep improving. And then I think it helps too to partner with other companies who already have bonding in place, and you can learn what they do, how they do it. They can give you tips on it, that kind of stuff. But that's what I had prepared for today, so I hope that was helpful.